Welcome back. Now, the slow pace of economic reform is weighing on growth. During the current climate, Moody's expects the economy to grow by just 1% this year, with a gradual improvement, 1.6% in 2026, while government envisions growth of 3.5% by 2030. The projection for next year is well below the 5% forecast for sub-Saharan Africa, but it's the most optimistic prediction among the three major ratings agencies. Kevin Lings, the chief economist at Stanlib, joins us with his analysis of the country's growth picture. Kevin, thanks so much for your time this afternoon. Now, we went into 2025 with pretty upbeat forecasts from Treasury, the SARB, as well as big financial institutions. Current conditions have somewhat dampened those forecasts, with most of the institutions, if not all, lowering their expectations on the back of the US tariffs. That aside, how are we faring when it comes to things we actually can control, right? The reforms. We are seeing things shaping up with Eskom, but the turnaround at Transnet still somewhat lagging.
That's all right. Essentially, the reform is continuing, and there are promising developments in the background, right?
Yeah.
So if you have meetings with National Treasury, if you have meetings with the Office of the Presidency, if you have meetings with Barbara Creasy at Transport, you're very aware of some of these significant developments. But I think what people maybe not being aware of is that it's all going to take a considerable amount of time to actually materialize, to result in investment, employment, which is what we really want, right? So the difficulty is that you hear all of these reforms, you hear about private-public partnerships, whether it's in the rail sector or the port sector, in water, etc. And people want that to materialize now. They want to see an improvement immediately, and they want to see growth and employment. And it's just taken an incredible length of time. And so I think that for this year and next year, the growth rates are not going to be particularly exciting. What Moody's has got, I think, is realistic. 1.6 for next year. It's a little bit at this stage on the high side, but I think it's within the realms of possibility. I see yesterday the IMF actually revised down South Africa's growth for next year to 1.2%. So they clearly are not buying into the reform process, right? But let's go with the 1.6%. The consensus in South Africa amongst economists is 1.5% for next year. So I think those are realistic numbers. The growth rates that we really need, the growth rates you refer to in the rest of sub-Saharan Africa, where you're growing at 4%. I think that's on a 3 to 5 year basis, where you've had some more time to get some of these reforms implemented. You've got private sector involved in critical infrastructure. Then I think, yes, the possibility for much better growth is realistic, but it's all just taking a huge amount of time, and it's creating frustration within the domestic economy.
You're absolutely right there, Kevin. I mean, I think average South Africans just want to start seeing changes on the ground level. We want to see more jobs. We want to have more money in our hands, you know. And just moving from that, National Treasury has also been praised for fiscal discipline and new cost containment measures. But, of course, Moody's is warning that growth remains too low to stabilize debt. How sustainable is our current fiscal path at this current growth rate?
So I would agree with Moody's in the sense that they're saying the National Treasury is being more disciplined, and so there is evidence of more fiscal consolidation. That's coming about from two factors. The one is that tax revenues holding up well, even though we don't have a huge amount of growth. The tax revenues in line with budget, and it's across most of the key components, right? Individual, corporate, VAT, all of those numbers are decent in South Africa. At the same time, if you look at government expenditure, it's behind budget. Now, you can debate whether that's good or bad, because obviously we need a lot of stuff developed, so you don't really want government to underspend, but given the efficiency of government spending, the underspending is perhaps not a bad thing, right? So we're on track to present decent numbers, the medium-term budgets on the 12th of November. I think those numbers will be decent. I think by the time we get to February, I think the government can show fiscal consolidation. The difficulty with the fiscal position is exactly what Moody says, right? So you've got a debt level that is sitting at 76%. You've got interest costs that is 20% of the total tax revenue, and so you end up being constrained. And you can't use government expenditure effectively to grow the economy in a very substantial way. So what it requires is that we get better economic growth, which then generates more tax revenue, which then puts the government in a better fiscal position. But where are we going to get the growth from if government itself can't really spend a huge amount? And so the answer is that's got to come from the private sector. You've got to get the private sector involved in a lot of these projects and get the private sector's balance sheet to lift the economy. And then hopefully when we get that underway, you get economic growth, which then frees up national treasury with a bit more tax revenue. As it stands right now, if we don't get more growth, National Treasury can't do much. They're going to have to keep on being disciplined. They're going to have to keep on pushing back on any big expenditure item. They're stuck in the sense that their current debt level and their interest cost is not giving them any flexibility. They can't afford to increase taxes dramatically. That would wreck the economy. They can't afford to cut a huge amount of people. That would also wreck the economy. So the question is, we're desperate for growth. The government has done a decent job in terms of their fiscal parameters, but we've got to get the private sector way more involved to lift the economy more broadly.
The private sector really central to driving some of these reforms, these projects that we do have. Let's bring in monetary policy, Kevin, just on the back of the ANC's latest economic plan, where the NEC is pushing to align fiscal, monetary and trade policy. What does that look like? How would it address current growth concerns, especially at a time where the SARB is looking to lower the inflation target, of course facing pushback on that because of the timing of the move, with many concerned about where growth is at the moment?
Yeah, that's right. So the Reserve Bank wants this 3% inflation outcome, and there's nothing wrong with that as an objective. It's a good thing, right? But obviously, as we go from where we are to get that 3%, it's going to inflict some pain on the economy. And that pain is going to be that we're going to be living with interest rates a little bit higher than we would have had, right? Now, is that damaging to SA economic growth in the short term? I don't think it's a major factor. In other words, let's say that the Reserve Bank cut interest rates more aggressively. Do I think the economy would immediately respond and become significantly more buoyant? I don't think so. The reason is I don't think interest rates are the main factor inhibiting economic growth and investment. I think the main factor is the lack of infrastructure and some of the policy ambiguity and some, quite honestly, the regulation within the business community. So I think if we want to lift the growth rate, we've got to focus on getting rid of the main factors stopping us growing, which right now is the economic infrastructure, the ports, the rail, and water, etc. If we do that, and then we're seeing, yes, there's more economic activity, investment from the private sector, then I think interest rates start to play a bigger role, and hopefully by that stage, the Reserve Bank's got inflation down to where they want, more or less 3%, and then you could get a massive benefit, because at that point you could cut interest rates significantly, because now you've got inflation under control, therefore reduce the cost of capital, therefore get the economy going. So I think the sequencing of how you get there is important. I can understand that there's a bit of angst with the Reserve Bank wanting to achieve that target right now. But I think that that's deflecting from the main issue. The main issue is we've got to develop this infrastructure to allow the private sector to flourish. And I think the more we look at these other issues, we're deflecting from what's most important, and that's not ideal. So I think the Reserve Bank needs to stick with what they're doing. I think they've done a great job. They've got lots of credibility. The inflation rate so far, we have to be honest, has been very decent. It has surprised on the downside. There's every chance the Reserve Bank achieves the 3% outcome. And then we get the benefit of 3% inflation. It's an enormous benefit, which is the lower interest rates and lower cost of capital.
All right, let's leave it there, Kevin. Thanks so much for your time and just walking us through, some of the growth expectations we could see for the country and what really is weighing on growth here at home. Now, that was Kevin Lings, chief economist at Stanlib.